I'm Calvin Koo, and this is your September 2023 crypto update. As a reminder, my thoughts and comments are strictly my own and not that of my employer. Nothing I say is intended as legal or financial advice. Starting in Hong Kong, where authorities have made arrests and frozen assets relating to a crypto exchange that had been promoting itself in town. As many of you know, Hong Kong's new crypto regime began on June 1st, including the ability for retail investors to trade cryptocurrency with licensed exchanges. There's a one-year grace period for exchanges already operating in the city to comply with the new rules and apply for a license. Currently, only 2 exchanges have that license, and both of these were licensed under the previous Hong Kong crypto regime for professional investor trading and have since had their licenses upgraded. On 7th August, the SFC, the Securities and Futures Commission, issued a public warning saying that it had, quote, observed some unlicensed virtual asset trading platforms engaging in improper practices, namely falsely claiming to have submitted an application to the SFC for a license. The SFC further noted that it had learned that some virtual asset trading platforms, or I'll say exchanges going forward for short, that some of them set up new entities in Hong Kong in anticipation of that transitional period, and that these entities were purportedly set up to provide virtual asset services in Hong Kong. Moreover, these entities publicly stated their intention to apply for relevant licenses, but the SFC cautioned that the services offered by those exchanges may not be compliant with the legal and regulatory requirements under the new regime. That 7th August warning, which did not expressly name any potential violative exchanges with specific detail, was aimed at 2 audiences. First, unlicensed exchanges or exchanges that were or are pursuing these alleged activities. The warning reminded them that not only would such activity reflect negatively on any future application, but that it may also be a criminal offense. Second, the warning was aimed at the investing public. The warning concluded by saying, quote, the SFC takes this opportunity to warn investors that some unlicensed exchanges are misleading the public by claiming to have submitted license applications to the SFC when in fact they have not done so. Other unlicensed exchanges may have publicly announced an intention to apply for a license from the SFC. But investors should be aware that these unlicensed exchanges may or may not submit a license application after all. Most exchanges currently accessible by the public are unregulated. As and when the SFC approves an exchange to provide services to retail investors, the list of virtual asset trading platforms published on the SFC's website will be updated. Once again, the SFC warns investors to be wary of the risks of trading virtual assets on an unregulated exchange. Investors may face the possible risk of losing their entire investment held on the exchange if it ceases operation, collapses, is hacked, or otherwise suffers from any misappropriation of assets, end quote. 1 month later, on 13th September, the SFC issued a second public warning, but this time they specifically named an exchange called JPEX, JPEX, as a platform that had, quote, been actively promoting its products and services to the Hong Kong public through social media influencers and key opinion leaders, or KOLs, as well as over-the-counter virtual asset money changers. The SFC went on to say that it wished, quote, to make it clear that no entity in the JPEX group is licensed by the SFC or has applied to the SFC for a license to operate an exchange in Hong Kong. The warning continued by saying, quote, the SFC has also observed a number of suspicious features about the practices of JPEX and those actively promoting it to the Hong Kong public. A, JPEX states on its website that it is a licensed and recognized platform to facilitate the trading of digital asset and virtual currency. It claims on its website and local advertorials to have obtained licenses from certain overseas regulators to operate virtual asset trading platforms, which is in fact not true. B, JPEX offers very high returns for some of its products. C, the SFC has received complaints from, and notes that there have been media reports of, retail investors who are unable to withdraw virtual assets from their accounts maintained with JPEX, or had found their account balances having been reduced and altered. D. Some of the products offered by JPEX appear to be arrangements involving virtual assets such as virtual asset deposits, savings, or earnings, which are not allowed under the SFC's regulatory regime for virtual asset providers. E. JPEX publicized on its website and local advertorials that it had entered into a business cooperation with and received investment from a Hong Kong listed company, when in fact, the cooperation has already been terminated and no investments were actually made by the listed company. F. Key opinion leaders and over-the-counter shops have made false or misleading statements on social media to suggest that JPEX had applied for a license in Hong Kong, either independently or in partnership with a Hong Kong listed company, when in fact, no entity in the JPEX group has submitted any license application to the SFC. End quote. So there, in this second warning, clearly the SFC went into much more detail about the red flags that it saw based on JPEX's business practices. So remember, that was on 13th September. And then on 18th September, Hong Kong Police's Commercial Crime Bureau, working with the SFC, carried out the first arrests in connection with investigations of alleged fraud at JPEX. Reportedly, bank accounts were frozen and properties were seized, with reportedly over 2,300 investors losing nearly $180 million so far in the largest financial fraud case in Hong Kong's history. The police said the case involved mostly inexperienced cryptocurrency investors who had no understanding of the products they were investing in. To date, 12 have been arrested, including influencers who allegedly promoted the platform and operators of over-the-counter exchange trading operations. Over the course of intense local media scrutiny over this last week, more information about the SFC's investigation was released. The SFC says the investigations into JPEX began in March 2022, with the SFC then putting JPEX on its alert list in July 2022, followed by multiple investor alerts against dealing with unlicensed platforms. Critics note, however, that JPEX wasn't specifically publicly identified until 13 September 2023, which meant certain retail investors may have been unaware that there were any potential issues with JPEX and instead relied on the various promotional material and high chance of returns that were being offered. This retail investor protection issue is, of course, an issue that the Hong Kong authorities, especially the SFC, along with authorities and regulators in many other jurisdictions, have been particularly worried about. And when we've talked in the past about policymaking and regulatory developments in this series, it's often with this issue at the fore. While some commentators have raised this development in Hong Kong as a potential negative mark on crypto in the city, and many agree that in the short term it may chill the crypto market in the city, arguably, it actually shows how the new regime is supposed to work. Exchanges need a license, and there is an enforcement wing to deal with regulatory violations. Unlicensed exchanges run afoul of the law, and it's no longer a gray area that that's a fact. And so violations, especially alleged crimes, will be pursued with likely prosecutions to follow. Hong Kong's chief executive has also stepped into this high-profile news in the city, reminding investors that they should only trade on regulated platforms, and that the government would step up education efforts about risks of investing on unlicensed platforms. Among other things, the SFC has changed its previous policy of not publicly revealing which entities had applied but not yet received licenses. It now identifies those publicly on its website, and we can see that 4 entities now have applications in with the SFC. And to be clear, this is beyond the 2 that I mentioned, which already have licenses. In announcing that change on 25th September, the SFC reiterated that it had long seen the potential benefits that this technology can bring to the financial markets, with virtual asset activities, quote, integral to the Web3 ecosystem, end quote. It reiterated that it was one of the first major financial regulators to introduce a comprehensive regulatory framework, and that in doing so, it identified risks associated with these activities, including decentralization, money laundering, and investor protection issues. The SFC added that this JPEX case, quote, highlights the risks of dealing with unregulated exchanges and the need for proper regulation to maintain market confidence, but that also investor education related warnings could be enhanced, hence the change in policy about identifying license applicants. The SFC concluded its announcement by saying that in collaboration with the Hong Kong government, it remained, quote, committed to ensuring the protection of investors' interests and market confidence, as well as fostering a business environment that facilitates the sustainable and responsible development of Hong Kong's Web3 ecosystem through properly regulated service providers, end quote. Now, naturally, JPEX and those arrested will have their chance to present their defense in due course. On its website, in a blog post dated 19th September, JPEX refuted the allegations and published correspondence with the SFC, which the SFC later said was itself another violation of relevant laws. Moving on to Singapore, where I actually happened to be recently for a major crypto and blockchain conference, bringing developers and professionals from around the world into one place. Anecdotally, I was struck by how many conversations this year were focused on longer-term development of use cases for crypto and blockchain technology, as well as a recognition of the reality of having to work within relevant regulatory frameworks around the world. There's also an expectation that in the wake of cases like FTX and now JPEX, that there's likely going to be more companies that face similar allegations and issues as the overall crypto markets and regulatory regimes around the world get more sophisticated and dig into these matters. Also, earlier this summer, there was a key courtroom development in Singapore. On 25th July, the Singapore High Court handed down a judgment in By Bit Fintech Limited versus Ho Kai Xin and others. As with other common law jurisdictions, it found that cryptocurrency assets are property. But notably here, whereas many previous common law judgments finding crypto as property were during a stage of the case that only required a good argument that it was property for the case to continue, in this By Bit case, the court was at a much later stage of the legal process, making this judgment arguably a more definitive statement on the notion of crypto as property. Moreover, in the facts of this case, the wrongdoer was found to hold those crypto assets on constructive trust. So in effect, although the person may have the private keys to control those assets, the law might say that the person is doing so in trust for another. So it is really the beneficiary of the trust that is the rightful holder of the assets. This further underscores that victims of fraud or other types of crypto disputes may have traditional remedies in common law courts derived from tools to recover other types of property. But the nuances of crypto, including accessing private keys and conducting tracing, which can overcome any obfuscation techniques on the blockchain, mean there can still be enforcement hurdles in practice. That's it for this month. I'll see you next time.